Hello everyone, this is Stock Martin. Thank you for joining me. Today we're going to talk about tax write-offs and the wash sale rule that the IRS has made that will prevent you from using your tax losses if you sell a stock at a loss and rebuy it within 30 days. So take a look at this video, check it out. Don't forget to subscribe to my channel, hit the thumbs up. Also share this with any friends, family members, and don't forget to comment. Go to the link below and get your 2 free stocks at Webull worth up to $1,850. You can also get $10 of Coinbase if you hit the link below as well. I hope you like this video and learned something. Let's check it out. If you sold any stocks this year at a loss, then the IRS will allow you to deduct it from your taxable income as a capital loss. For example, for any stocks or other investments that you lost your money. You can write those losses off in your taxes because the IRS allows you to deduct the maximum net loss in a tax year is $3,000. So the IRS limits the amount that you can write off in taxes to $3,000 for individuals and if you marry jointly. $3,000 is just good for that one trading year. If you're over that threshold of $3,000, there's nothing to worry about because this can roll over to future years. For example, if you had a net loss of $9,000 in one year, for that year you can write off $3,000. The $6,000 will roll over to the next year. For that year, again, you can deduct $3,000 and the final $3,000 you can use for the third year. So the losses do not expire. Today we're going to actually talk about taxes that impact your stocks, specifically the wash sale. The definition, we're going to talk about the IRS, why they put this rule into place, some examples of what can happen if you do have a wash sale. If you have any questions or comments, please leave them down below. Well, let's get down to it. We're going to talk about specifically the nasty piece of tax that the IRS puts every time that you sell a stock or any kind of entity at a loss. So especially the reason why I wanted to bring this up is because the stock market has been going through a big correction. A lot of people are worried about a crash. So if you're down on any stocks and you're thinking about selling, please watch this video, share it with your friends, share it with family, share it with that next door neighbor so they can be familiar with a wash sale. And this can help you extremely when you do your taxes. Well, the IRS actually created the wash sale rule to discourage people from selling stocks or securities at a loss to claim a tax benefit. So this is directly from the IRS website, which I'm going to post down below in the comments. A wash sale occurs when you sell or trade a stock or security at a loss within 30 days before or after the sale if, number one, you buy or you acquire substantially identical stocks and securities. Let's say you buy some Tesla. To make math easy, let's say it's $500 and price of Tesla goes down and you decide, oh no, the market is crashing or there's a big correction and it's dipping down to $400. If you sell at $400, you put in a $100 loss on that particular stock. If you rebuy it or reacquisition that same Tesla stock within 30 days, you're going to get a wash sale. And we'll talk about what will happen in the next few slides. Also, if you acquire a contract or an option to buy a substantial identical stock or security. So this also applies to options. If you're an options trader, if you do calls and puts, those you have to be very mindful as well, especially for that particular stock. Also, if you acquire substantially identical stocks for your individual retirement arrangement accounts, these are your IRAs. So let's translate this. What is a wash sale? So it is if your anticipated tax loss is not allowed, if within 30 days before the date that you lost the lost sale or 30 days after that date, you acquire the exact same stocks or securities. So what does substantially identical stocks and securities mean? Well, nobody really knows. For individual stocks, this is easy to know. Look at the example with Tesla. Tesla, if you buy or sell, you know what stock you're getting. Where it becomes more grayish is if you're buying mutual funds or if you're buying, for example, ETFs. So be very wary if you're let's say you have an ETF that's in the S&P 500 index. If you have an index fund and you sell it at a loss and within 30 days you come around and buy another S&P 500 index fund, that will count as a wash sale. And the IRS determines which of these stocks or securities is substantially identical. So be very careful on which stocks you rebuy if you do rebuy those, so you don't get that wash sale. So this is the point I wanted to make, and it's a very important slide. If you don't get anything away from this video, this is one of the most important slides. So if you have a wash sale and you're disallowed the loss on your taxes, what will happen when you purchase the stock back, it's going to add on to the disallowed losses to the cost of the new stock or securities that you just purchased. It's going to increase your basis of the new stock price. And I'll give that an example down below. There's only one exception where this doesn't occur in, and that's if you're trading in your IRA. So this is an exception within the IRA. Before I give you some examples, let's talk about very important things about wash sales. A lot of people might not know this, and it can get you during tax time. If you are filing jointly, let's say if you have a spouse or a partner that you're filing your taxes jointly, and if they sell any stocks and you go around and buy them in another account, let's say your spouse sells the stocks and you go in and buy the same stock in your account and you do your taxes together, that will still actually be used as a wash sale. So you have to be very careful, because the IRS will look at the two social security numbers, the tax identifiers, to see what stocks were purchased and what stocks were sold in all of your accounts between the both of you, since you're filing jointly. So that's a very important and little thing that a lot of people do not know, and that can get them in a lot of trouble and get them in this wash sale. Another big thing that a lot of people don't know, and if you're working for a company or a corporation that gives you stocks or shares as, let's say, bonuses, that you did a great job and they give you some stocks. Let's say they give you some 10 stocks for doing a great job in sales. Well, this is also counted income. If you go out and sell these 10 stocks that you were given as a bonus and you sell these at a loss, that can also be a wash sale if you go and rebuy those as well. So remember, wash sale rules apply equally to losses from sales from mutual funds as well as stocks. In fact, wash sales are quite likely to apply if you have an arranged automatic reinvestment of your dividends too. So be careful about that as well. I actually didn't quite know this until I did all this research, that dividends that are paid from that stock are also included in that wash sale. So let's say you have a nice dividend that's coming in, one of the high dividend stocks, and you sell those stocks at a loss. Those dividends are also included in there as well for tax purposes. So let's give an example. We'll give a couple examples here of a wash sale rule. So let's say you buy 100 shares of an X stock, let's say Tesla stock, for $1,000. Again, this is just an example. Then you decide you want to sell these shares for $750 at a loss because you notice that the stock market is tanking and you don't want to make any more losses. And then within 30 days of that sale, let's say you have a change of heart and you want to buy back the 100 shares of the same stock for $800. So if you calculate the difference, you cannot deduct the loss of the $250 from that sale. So if you bought it at $1,000 and you sold the stock at $750, there's that loss of $250 from those shares. But if you buy the 100 shares back, well, you won't be able to use that wash sale. However, what will happen when you buy those shares back, those 100 shares back at $800, this is going to add your disallowed loss of $250 to the cost of the new stock of $800. So technically, your basis of the new stock will actually be $1,050. which comes from the $800 plus the $250 loss gets added onto that stock. So you have to be very careful. So you're really not buying that stock back at $800. You're actually buying it back at a more expensive rate because you have a new cost basis because of the added disallowed loss. Example 2 is, let's say you are an employee of a corporation and they give you a bonus award of 10 shares of stock of that corporation that you're working for. Later you decide to sell these 10 shares at a loss, and within the 30 days, let's say you have another award, within 30 days you won't be able to deduct that loss of that sale that you had just made. So these are some examples of the wash sales. I hope you like this video. Very important to be careful when you do make a sale of a stock at a loss or a mutual fund at a loss. If you do not want the wash sale rule to apply, make sure to start trading at least on day 31 or longer. Do not trade or do not buy any more stocks within 30 days after selling that stock. Thank you again for watching my video. I hope you enjoyed it. I hope you learned something. Please share this with your family or friends. Give it a thumbs up. Don't forget to hit that notification bell, hit all, so you can get all my videos. Check out my other videos that I've made. Also, don't forget to get your 2 free stocks from Webull, valued up to $18.50. You can also join Coinbase and get 10 extra dollars just by joining Coinbase if you use the link down below. Thank you again, and don't forget to plant that seed, watch it grow, live and learn, and teach everybody out there. Thank you for watching, and have a great day. Until next time.